Welcome everyone. It's right at the top of the hour, so I thought I would go ahead and get started. I'm Denise Sober, and I'm really happy that you guys have joined me today. We are going to talk about pausing, resetting, and then hitting play on our company again, and how we can use our financials to make really important decisions to help us survive and thrive. If you guys have questions as I get going, at the end of the webinar, I'll address those, and you can enter those through the Q&A kind of chat feature. So if you'll try to keep that to questions, that way I can scroll through those at the end. I would love to help you guys out in any way that I can. A little bit of background on myself is I have an accounting degree. In my prior life, I was in financial systems management, and I did managerial accounting for tons of different types of businesses. And I'm also a certified Cognos and Microsoft report developer. So I have a little bit of coding skills and some SQL writing skills. And so I have kind of a mix in my prior life, but I grew up in a jewelry store. My parents owned a store in Texas, and I believe jewelry always calls you back home. And I was called back to the jewelry industry about 6 or 7 years ago. So I'm currently a merchandising consultant for Buyers Intelligence Group. I also help facilitate their Plexus performance groups, and I do the financial presentations and analysis for many of the Plexus groups. And then I also have a foot on the retailer side. I work with my brother closely to run his business. He owns it, and I lead up the merchandising and buying team. And I also do all of the financial planning and budgeting for us. And this is something that some of the AGS members that I've been speaking with have said, hey, this could help more people. Why don't you do a webinar? So I'm here on behalf of Just Big and our jewelry store to just try to help you guys out and tell you what's working for me, and hopefully it'll help you guys lead during this time. I fully believe you do not have to be an accountant or know how to create financials to be a good business person and run your business by the numbers. That is absolutely, we have all, accountants have gone to school for many years to figure out how to get things in the right bucket. That is not something that I want to spend time teaching you. That is something that if that is not your gifting, then I hope you can hire someone to do that for you. But what I do want you to do is know your numbers and own your numbers and know how to make financial decisions with those numbers. So that's where we're going to pick up today, is what do I do? How do I run my business better and more successfully? And let's use our financials as kind of the tool. So today's agenda, we're going to talk about pause, reset, and play. That has been the theme of the way I'm an accountant, so I categorize everything. So as we've been going through the last month and a half that no one saw coming, I've been thinking in my mind, what do I need to pause right now, but I'll turn back on in the future? And I'm using cash, simply cash. How much cash do I have to make those decisions? And then I'm using the next phase, the reset. What expenses or things do I need to permanently make a change to? What do I need to reset in my mind or in my business to make it more successful in the future? These are more permanent decisions. And for that, I use a break-even analysis and my contribution margin, which sounds scary if you're not a numbers person or an accountant, but I'm going to break it all down for you. And I'm going to give you a spreadsheet. So you just have to type numbers in and it will spit out your break even and your contribution margin for you, so that you don't have to get bogged down in the accounting of it. You can just use the numbers to make financial decisions. And then last, when we hit play, what do I want my business to look like? What changes do I need to make? What are some good best practices that I can have moving forward? I'm going to reference a couple of spreadsheets throughout today. Those are all free to you guys. You can find them at the bigjewelers.com website, and you can go under resources And you'll see we have a break-even analysis that you can download. We have some cash budgeting and forecasting tools. And for those of you who, we get a lot of questions about chart of accounts, we have a sample chart of accounts for you guys as well. So these are all tools that you can download free of charge. They're yours. I do have them protected. So when you open the Excel file, you can't mess with the formulas. However, there's no password on it. So if you're an Excel whiz and you want to change them up, unprotect them. Once you download it, this is yours. Change the titles, make it yours, make it work for your business. Okay. So when we talked about pause, as I mentioned earlier, cash is king. Right now, more than ever, we're realizing how important cash is to a business. Liquid cash that we can get our hands on. No one ever expected the business to just stop, and it did. And so right now the game is whoever has the cash has a business, and if you run out of cash, you run out of business. And so the key right now is to stretch our cash as far as we can. And what do we need to pause or stretch out in order for us to survive the right now? So we're going to use cash to make some decisions, and I'm going to show you how I'm doing that. So when I'm doing cash planning, again, like I said, I compartmentalize everything. I like steps. So for me, the first thing I did is I pulled a list of what do I spend monthly. We all know in our heads what we spend monthly. We see the checks coming in and out. But what I did is I pulled credit card statements. Don't forget your credit cards because that is cash, even if you don't have to pay for it immediately. But I pulled credit card statements for several months, and I pulled all of the checks and the things that had come out of my bank account. And I grouped them, and then I kind of made a list of this is what I spend monthly. So I could really get a firm grasp, and it wasn't just up in my head with a tally that I'm keeping mentally. Then I went through and said, how much cash do I have to pay these bills? And this is not my bank balance. I'm not logging into the bank and saying I have $2 million in the bank. I don't, but I'm not saying this is my bank balance. I'm saying what is unaccounted for cash? We all have checks that we've written that haven't cleared in different situations with our cash. So your unaccounted for cash, the cash that is free to you right now that you could write a check for and you wouldn't bounce your account. So I came up with my cash number, and then I made a list of my resources. So step 3 was my resources. Not only do I have a banking account, but I also have a line of credit. And so what does that look like? How much do I have available to utilize on my line of credit? And do I have any other cash resources? In this case, many of us have the PPP plan that has either funded us or you'll be receiving the money soon or you're anticipating it. Maybe it's the EIDL loans. Whatever it is, write out what cash resources you have. Step 4 is to come up with your list of trade payables and debt. That may have been included some in step 1, but if it's not, don't miss this. We want to know how much we owe our suppliers and how much we owe in debt each month. And that way we can make sure we account for that. And then the last, step 5, the most important, is to now put those all together and plan your cash activity. So step 5, as I typed it, strategically plan your cash activity. It's like, great. We've heard lots of people say that. That's super important, but man, is it daunting and overwhelming. And so I, for myself, created this spreadsheet. This is a spreadsheet that has been, I worked with someone many, many years ago as a base, and then I've kind of taken it and morphed it for my business. And I want to share it with you guys, and you can take it from here and morph it for your business. So I'm going to pop over. I'm actually going to open it live for you guys, and we're just going to talk about it. Again, you can download this right off of Balance to Buy's website. And that way you don't have to recreate the wheel. You can just pick up from where I left off. So when you download this from the big website, you'll have several tabs. There's a weekly cash plan. Many people like to plan their cash flow weekly. I personally am a monthly cash flow planner. So we're going to look at the monthly cash flow plan. It's going to come in like this, blank. Anything shaded has formulas and will automatically populate. So you can see if I were to type in advertising, how it begins to populate. The top of the spreadsheet shows us our projected beginning bank balance. So I've started an example for us today, so you don't have to watch me type into this. So I'm going to take this monthly cash flow plan that I downloaded, and I don't care anymore about January, February, March, or April. That is behind us, and most of those bills have been paid. So we're about to launch into a new month, so now is the perfect time to jump into this cash planning. So I'm personally going to just delete these and start right with May. And and so now we have a spreadsheet May through December. And my goal with this spreadsheet is to use those expenses that I've identified in my cash resources and figure out how we can get those and stretch those. So I filled out this spreadsheet quite a bit. I've added like a projected advertising budget, rent. You can see with advertising, it had been minimized, but as we head to fourth quarter, I plan to increase this. Rent across the board, how much telephone and utilities. I've tried to think through the different expenses that you have as a company so that this will help walk you through and think, oh, I forgot about that, that professional service that we have with that consultants, and I want to make sure I pay that person. So I've tried to walk through this. General insurance, this is something that most people pay quarterly. So you'll want to put those quarterly payments down in the month in which you pay them. So this spreadsheet is not to mirror your P&L. This spreadsheet is truly what cash do you plan to literally spend and outflow from your bank account. Plan that out. As you type in your expenses, it will begin totaling for you guys, and you can see your average net outflow. I have not put in my payroll yet. I wanted to do that with you guys. So let's say we pay twice a month on the 1st and the 15th. And right now, while we're closed, our baseline payroll is about $45,000 a month. So I'm putting baseline payroll because right now, unless I know I'm opening, I'm planning conservatively, and I'm not starting with sales. Sales is both an uncontrollable and an unknown. So I'm not using sales as a foundation to make financial decisions because that would be a pretty rocky foundation. So I'm using cash right now as my decision maker. And so this is your cash in area, and I'm leaving it blank for now. So I know that my bank account balance right now is $150,000. So when I enter $150,000, I can see how I'm going to spend this $150,000. I'm going to have some payroll, and at the end of May, my bank account balance, if I pay according to my plan, I should have about $83,000 left. And that will get me through June. At the end of June, we'll have about $14,000 left. So I'll be starting July at $14,000. So as you begin to use a spreadsheet, you can see at what point are you going to run out of cash. So I can see in this example, by July, I need to have some sales, or I'm going to need to use some additional cash resources. The other thing I have not put into this is my accounts payable payments. I'm going to put all of my other payments in here, see what my cash looks like, and then I'm going to plan out my accounts payable according to how much I think I can pay my vendors and keep my business afloat. So in this case, let's say I'm going to pay $15,000 to vendors for the next few months. And what does that look like for my cash flow? You'll notice now I end June now negative. So in this case, I have the ability to use my line of credit. And so I can start planning out my use of line of credit, or this is where I start saying, I'm hoping that I can start getting some sales coming in. And so I think for May with Mother's Day, even if we're closed, I think we can garner up, say, $40,000 in business. And if we get just $40,000 in business, in sales in May, you can see all of a sudden now I'm pushing back into July for my cash flow. So I'm going to give you the spreadsheet. I want you to play with it, fill this out, and run scenarios for yourself and think through the best use of your cash resources. And then this is where you start thinking about pause. As you look at this and you realize I have no other resources for cash, and I'm going to run out of money in July, and I don't think sales are going to be enough to cover it. What can I pause? Maybe I need to not increase my advertising so quickly and keep this at baseline advertising. So you can adjust these amounts and see how it affects your cash flow in real time. You can ask for rent deferral. You could, maybe you need to pause some of your professional services and fees. Maybe as you look at your accounts payable, you just can't afford to pay this right now. These are decisions that in your mind, you're probably figuring these things out, but if you put them on paper and make a plan, you can be strategic about what you're doing and the decisions you're making. So this is how this is the tool I'm using to decide what I need to pause and how I need to allocate my funds. The key to the game is stretch your cash as far as it can go. The first one out of cash is out of a business. So stretch that cash as far as you can go and make a strategic plan to really stretch that out. Okay, back to the PowerPoint. So the next section is after you've figured out how to pause and to get through these next few months and come out breathing, you've got to start thinking about big picture, your business. We can't just write this year off and say, well, I'm going to be negative. It's a toss-up. Well, that may very well be true, but man, we're going to go down fighting. And how are we going to make those decisions about who needs to go, what needs to be reset? Well, the tool I use is the break-even. Break-even is my jam. If you've ever talked to me, I've probably mentioned contribution margin percent or break-even. It sounds way fancier than it is, so don't get overwhelmed by the term. It's simply, break-even is simply saying, how much in sales do I need to have zero profit? Knowing that number is key when you're making decisions to know if you have enough built-in margin to enable you to have a profit and to get through this year. So let's really dig into it. The first step of your break-even is what's called contribution margin. To get your contribution margin, you're going to take your P&L or your income statement, same report, different name, and you're going to break it into its parts. So you either have sales, revenue, or you have expenses, and your expenses are going to be broken out by variable or fixed. I literally take this report, export it into Excel, and type next to each account if it's a variable, fixed, or sales, so I can just sort it. We will dig into variable and fixed expenses here in a second. Once you've categorized that, it's just a math equation. It's 1 minus variable cost divided by sales. Again, I have a spreadsheet for this, so you can just type your numbers in. You never have to do math, and we'll keep it simple for you. So let's really dig into variable and fixed expenses. Okay, a variable expense is an expense that automatically increases or decreases as sales fluctuate. The best example I have of this is commission. You have no sales, you have no commission expense. You have large sales, you have large commission expense. So a variable cost is directly tied to the top number of sales, top dollar sales. The most examples I could come up with is typically your cost of goods sold. You can see that is showcase, special order, memo, your cost of repair, cost of custom jewelry, and if you have an allocated cost of goods sold. We all know that we can't just adjust the cost of the items that we're selling. So in order to, reduce your variable costs, in this case, you have to work with margin. You would have to increase the price of sales. So we'll look at what an increase in margin will do for you. Variable costs are very hard to adjust because they are tied to sales, and typically they're pretty lean and mean. They're not the areas where we throw money away. Other examples of variable costs are your commissions and bonus structures, your bank card and merchant fees and bank fees. I typically see that as about 2% of people's top line sales. You can fix that a little bit if you think you're on the high side by finding a new credit card processing company, but for the most part, most of us are probably have that down as lean as we can possibly get it. And then there's postage. We know that postage is pretty tied to the sales volume that we're doing, both in and out. And so as you look at this list, I'm sure many of you are thinking there's not a lot of ways where I could cut these expenses any more than they're already being cut. And you're probably right. It's still worth looking at. Look at your freight charges and make sure you're doing it the most cost-effective way that you can. Don't ignore it, but this is more difficult to move the needle. If you want to move the needle with variable costs, you're going to do it by increasing your margin. Just as a quick example, I put $1 million jewelry store up here, and you can see $1 million jewelry store who puts key on their items would have $500,000 in gross profit. If you were to take the same sales and the same goods and put a 2.2 mark on it, you would have $545,000 in gross profit. And then compare that with 2.5, where you have $600,000 in gross profit. So the difference between marking your items at key and 2.5 is $100,000 for every $1 million you sell. If you do that math in your head, I'm sure, and that's cash. That's cash to the bottom line. So as you do that math, you can see why it's so important to work your margin. You can see discounting. Discounting is you've got to be very careful with discounting. So let's say that you go with the most margin at 2.5 margin, but you typically give a 15% discount, no questions asked. It's just kind of easy. It's part of your culture. Look at what that does to your bottom line. That gives you a gross profit percentage of 45%, which is less than key. So really monitoring your margin is really important for you to make sure that you have enough margin and cash in your business. Fight, as Abe always says, fight for every percent. If you guys are at 50% for your gross profit right now, fight for 51%. Fight for every percentage. Just keep moving the needle in the right direction. Now, fixed costs are different than variable. Variable are tied to sales, and they increase or decrease as sales fluctuate. Fixed costs do not. Fixed costs are the things that we have to pay regardless of sales. I'm sure you know what that is, because right now we're not making money, we are closed, and we do have expenses, and that really sucks, right? So as we look through this list, you can see direct labor, people. For those that are still paying their people, our people cost us money. Employee health insurance, advertising, marketing, store supplies, rent, general insurance, professional services. As you look at this list, vehicle expenses, what you pay yourself, telephone, utilities, this is the list that you have more control over. This is the list where you can really try to trim and be as concise as possible. When we look at your break even, if you're not comfortable with it, if you don't have a lot of space between your break even and the sales that you've had in the last rolling 12 months, if those are close together, you need to find some space, because you don't want to be right up against your margin, because any blip in sales means you're losing profit. So this is the list where I would start with a fine-tooth comb and go through here and fight for every dollar that you can save in these areas. I get lots of questions about, should I have more fixed costs or more variable costs? That is a personal decision. Our store is in the oil industry, and so we have wilder swings than the average economy does. So in our case, I choose to have more variable costs because my sales are more likely to be a roller coaster, and I want my cost to mirror that roller coaster. Let's say you've chosen fixed costs. If you have more fixed costs, as sales increase, your profit percentage will increase. Let's use rent as an example. If you had $100,000 in sales and your fixed costs like rent are $100,000, you have, if you have $1 million and your fixed costs are $100,000, you have $900,000. Well, if you go up to $2 million in sales and then your fixed costs didn't change, and so now you have that much more profit. So as sales increase, your profit percentage increases, but as sales decrease, your profit percent decreases. So with more fixed costs, it's a gamble. You're saying, as sales increase, I want that money, I want more money. That's great. But when sales stop, like they did now, you can go negative profit. Compare that to variable costs. As sales increase, your profit percentage is the same because they're tied to each other. As sales go up, your expenses go up. As sales go down, your expenses go down. The frustrating thing about that is you keep a pretty steady percentage bottom line. It's that question of, why are sales up so high and I still don't have any more money or any more profit percentage-wise? Well, that's because everything's tied together. But the good side of that is, theoretically, assuming you could make your whole business variable, and we know that's not the case, but you would never have negative profit. So we all have a combination of fixed versus variable. This really plays into people. I get a lot of people saying, should I pay commissions or just hourly? That's a decision that you need to make for you, but I want you to understand how that decision affects your financial viability. So today we're going to use this example. This is a real store, and I had their financials, so I'm using this. They're a $1 million store, and they had a variable expenses of $582,000 and fixed expenses of $460,000 a year. We're going to use the contribution margin to answer these questions. I use contribution margin and break even to answer all of my questions. So I'm going to show you how I use it. Let's say you have a new vendor. You're at a buying show that I'm sure we're all missing, and we all wish we could go see our industry peeps at a buying show, but we're at a buying show and you found a line that you love, or you're working with a current vendor and they want you to invest more into their line and they want $35,000 from you. Should you do this? It might be a smart inventory decision on your part, but you also have to clear it and make sure it's a smart financial decision. So let's look at that. If you had that $35,000 opening order, what I do is I take that $35,000 opening order, I consider that a cost of investing in my business, and I divide that by my contribution margin. So that $35,000 investment, in order for me to recoup that money back, I would have to have $81,000 in sales to recoup my investment. So then I look and I say, do I think that I will have $81,000 in sales this year to recoup that $35,000 investment? If the answer is yes, it's a great business decision. If the answer is no, or that would require a 30 or 40 or 50% increase in business in that category or that vendor, and I don't think that'll happen, then even if you love the inventory, it's not a sound financial decision for you to make at this time. So in that case, I would barter this number down to match, what I think I could get a return on my investment. Now, this is a different way of thinking about inventory. And I had a client call me this week and they said, I have a vendor that wants me to spend $20,000 and then they will do X, Y, and Z for me. Well, I said, that's great. Let's look at that. Well, when we did the math quickly in our head, it was like, you'd have to spend about $42,000, $45,000 in sales to recoup that. And he was like, that's probably not going to happen. And so we made a good financial choice not to go with that deal, even though it sounded sweet. Another way to use the contribution margin. I'm thinking about doing a $5,000 advertising campaign for Mother's Day. What does that look like? As you take that $5,000 and divide it by your contribution margin, remember we have a spreadsheet, so that contribution margin is going to be given to you. I would need $11,000 in sales before I make any profit. That's just to break even. So if I am going to spend $5,000 on this Facebook post, do I believe I'm going to get $11,000 worth of sales just to break even, just to pay for that $5,000? And then I would need sales on top of that to give me profit. So that's how I use the contribution margin to make some of these decisions. It's still a guess on your part or a decision on your part. Do I think I'll make those sales? But at least it's an educated guess. A lot of people think I spent $5,000. So when I have $5,000 in sales, I broke even. I got my money back on that campaign. Well, that's not true because we all know we have expenses to each of those sales. You have to account for those. Okay. And last but not least, this is important. What is your break even? How much in sales do I need to have zero profit? This is referred to as your break even. It's the same math equation we've been using, and it's just your fixed costs divided by your contribution margin. So in this case, in that example I gave you, they had $460,000 a year in fixed costs, and their contribution margin is 43%. And so that gives their break even is $1,060,000. Now, if you go back to that example and you remember what their sales were, they were sitting right at $1,028,000 in sales. So just running their break even, they're already running negative. They're already running into the red. So in this case, it's not even that they have enough room in their break even to have a little downturn in the economy and still be profitable. In this case, they're already running a business that's not profitable. If you don't know what your break even is, then you need to know what that number is so you can know in your heart of hearts if you're running a profitable business or if now's the time to make the hard decisions. My brother monitors break even on a monthly basis. We calculate it on a rolling 12, and he uses that to say, when do I need to make the next hard choice? If we are trending, our break even is going up and our sales are going down, then we need to make changes. And what changes would we make? I can hear someone asking that now. Immediately go back into those fixed expenses and pare it down. And if you're really, really off, you have to hit one of the big expenses, which is people or advertising. When you're thinking about people that you need to get rid of, if those people are paid variably, they're all commission-based, then if you fired a commission person or a variable expense, it does not change your contribution margin. It does not change your break even. because they basically pay for themselves with their own sales, theoretically. So you have to be really smart about who you're getting rid of. You've got to get rid of that number, that person that gets paid regardless, because that's cash you're spending when there are no sales. I'm sure this makes more sense now than ever before, because we're in that position where we have expenses that we are paying now and we have no sales. In the past, it would be like, oh, you're crying wolf, that'll never happen. Well, it's happening. Okay, so just to summarize your break even, it's really important for you guys to know what that is. Let me show you the spreadsheet that I have for you. This is on our website. Everybody, hopefully you're still awake. Are you guys still out there? I don't want to lose you. There was a lot of math talk, but the important part is this. Focus on the spreadsheet because it'll do all the work for you. So when you download this from the big website, you'll come in and this will be blank. I went ahead and filled it out for you. You'll see 3 tabs at the bottom of this spreadsheet. The first one allows you to enter in your expenses so that you can, so it will automatically calculate your break even for you. So we have generally come up with, in most cases, what people's expenses are on their P&L, and we've allocated it for you into variable, fixed, and sales. So in this case, in that $1 million store that I found, I have just copied and pasted essentially their P&L into this spreadsheet. So you can see they had about 757 in sales and 137 in memo sales. You can see their cost of goods is entered, employee health insurance, commissions versus the hourly rate. Break that out because part is variable and part is fixed. So you can fill this spreadsheet out, enter the numbers. You don't have to do any math, and it's going to total it up for you. In the second tab of this worksheet will automatically, as you type those numbers in, it will update this spreadsheet and it will give you your contribution margin and your break even. Now, this is when it becomes break even. A lot of accountants think of break even as this is your number looking back. I look at this as my number going forward. So when I look at this and I can see my break even is over what my current rolling 12-month sales are, I'm going to come back over here and I'm going to focus on these fixed expenses. I'm going to figure out how I can minimize this a little bit to get profitable. So I might have to take my advertising down, let's say 3% or 5%, but let's take this down to 15,000 for this year. And let's take our digital marketing from about 50,000, let's take it down to 45. Let's just see how these changes. Oh, of course, my Excel is going to be. I've got to, let's see. Don't you love when this happens? I'm going to close this one. There we go. There we go. Okay, so you can adjust these fixed cost numbers and look and see what that's going to do. Okay, so for professional services, on average, we spend $12,000 a year. What would happen if I take this down to 8,000? So as I'm making these changes, I can come back over and you can see how this is automatically adjusting my break even for me. And I can see how my business decisions are affecting my business and my profitability. To me, this is magic. This is so important. Instead of guessing what your sales are, forecasting sales and trying to plan, to me, I want to be monitoring this against my profitability and not use sales as the guiding factor, but use my break even because it uses a percentage of sales. So even if my sales went to 0, my break even would still be 1,038,000 right now. So it's an interesting concept, but something you should definitely play with. And then the last tab is a standalone where you can run scenarios individually if you don't want to fill out the bigger spreadsheet. So you can actually type in this field and say, you know, in this case, you can say, you know, I have if your contribution margin, if it's typically like you got $53 for every $100 in sales, like your cost of goods, your contribution margin is typically 47%. You can just type it in like that and then run your scenario. So spend $5,000 and now that's that $10,638 that you would need to recoup for this investment. So hopefully you have an accountant or some other nerdy number loving person on your team if this is over your head. If not, I'm happy to talk to you about it because I just think that break even is such an important lens to make your financial decisions. Okay, and now let's talk about pressing play on our business. What are things that we can do to make us unsinkable? Remember, it is not about top line sales. You can be a $10 million store, but if you're not keeping a good portion of that cash in your pocket, it means nothing. It is not about how much you sell. It is about how much you keep. It's the old adage of vanity, sanity. Vanity is top line sales and sanity is gross profit. And then reality is cash. How much cash do you have? That's what's impressive. So let's look at this. How can you be unsinkable? How can we build an unsinkable ship? I'm just going to say it is not by chasing top line sales. You have to be honest about the business you have today and this year, not about the business you're building to in 4 or 5 years. What are you running and building right now? Who are you? Run your business for what you are right now. Forward thinking, of course, but be smart about who you are and be truthful with yourself. It's not about chasing sales. It's about reducing debt and stockpiling cash. That is the only way to be unsinkable. So let's talk about how when we hit play, we can change our mindset from if I just reach this number in sales, I'll be unsinkable, to if I can have this much money in the bank, I'll be unsinkable. That's more important. Okay, here's my 5-step plan to take us from a payables debt culture to a cash culture. Number 1, I would do, and you may change this up, or you may have a consultant that disagrees or changes these numbers by a little bit. That's great. My thing is just have a plan, think through this, and make your own 5 steps. But this is where I would start. 3 months of cash to cover shutdown costs and base payroll. If this resurges in the future, you want that cash in the bank to cover you for 3 months if the door is shut down. What number is that? Everybody's is different. Figure out what yours is and get that, save that money and put it in the bank and don't touch it. Number 2, after you have that pool, step 2 is pay off your line of credit and your vendor payables. Pay them off. Start switching to you have cash in the bank, so now you can buy inventory. Instead of I need inventory, I'm going to buy it now and hope I have sales to pay for it. Thought process change. Let's get strategic. It won't change overnight, but let's get strategic and start thinking about this a little bit differently than we have in the past, because if we want independence to survive, and we do, we're going to have to change the way we do business. So pay off your line of credit, pay off your vendor payables, and start paying ahead of time. Have cash in the bank, and then go to the show and say, I can spend, because I have $50,000 in the bank, I can spend $50,000 right now. After you have made that switch, my next step would be save more money. So originally we had 3 months of baseline bills. Now I want 3 months or 6 months of all expenses. If I were to drop in sales but keep everything going full speed, what does that look like? Put that cash back. Cash is king. It will make you feel a lot better, and you will sleep better if you have that cash in the bank. And then last but not least, pay off all your debt. Pay off anything, and then at that point, you have shifted to a cash culture, and you would be unsinkable. Okay. What does this look like? That's great, but we have no money and we have no cash. I've tried to do this for years. There's no way in the situation that we're in to get to where you want to go, to get to those 6 steps. You are correct. We have not gotten ourselves in the positions that we are financially overnight, and we will not get out of it overnight. But Never before have we as an industry or as an economy as a whole had the opportunity to reset and refocus and have an excuse, or have the bad guy not be us, but be the COVID shutdown, to make us make hard choices and hard changes. What does this look like for me? How do I produce more cash, save more money? Number one is your money and your savings account happens before you pay bills. So when you take your sales every day and take a portion of that each night and transfer it to a bank account, that percentage is going to be dependent on you and what you can do. You may be able to only start with 1%, but you know what? That's 1% you're putting in savings that you weren't putting in last year. And it'll add up. Start somewhere. But before you pay bills or do anything else, put a portion of your money, your sales that you make, that cash, put it in a bank account. Don't touch it. You also want to make sure you protect your sales tax, commissions, and your payroll. So top of the line sales, make sure you know kind of how much you need and pay those and keep that money. Key is get some money in a savings account that you don't touch and you do not have allocated for. A lot of us put money back in savings for our business taxes at the end of the year. Well, you're not building a savings account. You're building a tax paying account. Build a savings account. Number two, after you've got a structure in place to cover those, we do hold checks. So what we do is every night we run a report of all memo items that we sold, and we write a check in our system. It doesn't mean we print it and mail it and send it to the vendor, but we hold that money because that vendor has gone out on a limb for us and said, hey, I'm not going to make you pay for this. I've had to pay for it. I'm not going to make you pay for it. You can set it in your store, but please pay me as soon as you pay for it. Look, this industry is dependent on our vendor and retailer relationship, and we need our vendors as much as we need clients. It's all together. We're all in this together. We have to take care of each other. So if your vendors put their neck out on the line to give you memo, make sure you're paying them for that. So hold that money. Hold overhead payments. You know your utility bills are coming. You know your rent is coming. But hold checks in there so you can hold that cash and not spend it. And then any debt payments, any payments you know you're going to make, hold that money. Then you see how much cash you have left after that and allocate how much you can pay your vendors. It's a different way of thinking about cash, but you've got to be strategic about it. There's no other way to get a savings going except for to just start doing it and start putting money back in a savings account. So when I think about what to pause, I'm using cash right now as a guide to get me through the next few months. What do I pause? I'm going to turn back on as soon as I can afford to, and sales get back to normal. I'm using cash when I'm thinking about my business as a whole. What permanent decisions do I need to make? I'm using my break even to decide how I want to make permanent decisions and which ones I should make. And then lastly, when I'm thinking about hit play, my goal is to turn more into a cash basis. I want to be more unsinkable. How am I going to do that? Well, I'm going to do that by having a 5-step plan. So my priorities are cash. Keep that as your priority, and then have cash management plans in place to say, hey, this percent every night of sales is going into a savings account. Okay, so that kind of concludes what I have for you guys. I'm going to come over and check the chat feature. I have 2 questions. What would calculate a break even for an employee? So so you can use, that's a great question. How would you see how much an employee needs to make to pay for themselves? So you know your contribution margin, and then you would take that employee's total gross pay and whatever they're obligated to, like if you pay their health insurance, take that number and divide it by your contribution margin, and that's how much in sales would need to cover that one employee's expense. Hopefully that's not clear as mud, but The cool thing about contribution margin and break even is it's all the same calculation. So you would just take the total cost of that employee and divide it by your contribution margin, and then compare that to their sales and see if they're at least covering their own Heinies. If you have any other questions, I'll give you a couple more minutes. You can type those into the Q&A. I hope some people have hung on with me through this whole call. Like I said, this is just what I do. If you guys have a better process or are doing something else, that's great. The key is I just want us as an industry to move forward in the right direction. Okay, hey Jeff. Okay, guys. Well, please go to the big website. If you, oh, it looks like there's a chat feature. Okay. Please go to the big resource website and pull those spreadsheets. If you have any questions, you can email me. We're just here to help you guys in any way that we can. I just want this independent industry to just be stronger than ever when we come out of this. There's no better time than now to gain market share in your industry. Let's quit looking at this as a crisis and look at it as an opportunity to move our business and propel it in the right direction and be stronger than we've ever been. I'm excited for you guys. Thank you guys.